Today's topic: irrecoverable debts. These are amounts owed to the business by trade receivables and believed it will never be paid back by trade receivables. On 1st of Jan 2006, irrecoverable debts amounted to $100, and on the same date, trade receivables amounted to $12,000. On 31st December 2006, further $50 were identified as irrecoverable debts. The first two information appears to be at the beginning of the financial year, therefore it doesn't include any double entry. However, for 31st 2006, you need to identify the double entry. The double entry for irrecoverable debts: debit irrecoverable debt account and credit trade receivables account. Now, before preparing the ledgers, it is very important to identify the debit and credit impact. If you have a debit and a debit, it increases the debit value. Debit and a credit reduces the debit value. If an account has a credit balance, credit and a debit gives you a reduction in credit. Credit and credit will increase the credit value. Now, in this example, you're supposed to reduce your trade receivables. Therefore, you're supposed to credit your trade receivable account, whereas you're supposed to increase your irrecoverable debts. Therefore, you're supposed to debit irrecoverable debts account. So you credit trade receivable and debit irrecoverable debts. Now, let's look at the first step. Post opening balance of TR to TR ledger on the debit side. Why are we entering it on the debit side? Trade receivables do have a debit balance as per debt click. What are the steps? Include the date, balance brought down because it's at the beginning of the financial year, followed by the amount. Now, let's look at the question. Right, let's move to trade receivable account, which is worth $12,000. So we're completing the first step. So 1st of Jan 2006, balance brought down, enter 12,000, trade receivables account. We're done with this step. Post opening balance of irrecoverable debts to irrecoverable debt account on the debit side. Why on the debit side? Because irrecoverable debt is classified as an expense. Steps: date followed by balance brought down, amount. Now, let's move to irrecoverable debts account. The opening balance is 100. 1st of Jan 2006, balance brought down. Now we are done with step 2. Step 3. Identify the double entry for irrecoverable debts. We already identified irrecoverable debt account debit and TR account credit. Debit irrecoverable debts account. So let's go to irrecoverable debts account and debit the value of 50. Sequence, end of year date, opposite account's name, which is trade receivables. Now you're done with step 3, a section of it. Now, credit trade receivables account. Date, opposite account's name, irrecoverable debts, followed by the amount. Let's move to trade receivables account, and we're going to enter it on the credit side as irrecoverable debt. worth 50. Right. Now, to get a balance of the irrecoverable debt account. Irrecoverable debt is a category of an expense, and therefore it only appears on the income statement. So how are we going to balance it? Now here is an example of balancing an irrecoverable debt account. On the debit side, you get 10 and 2 gives a total of 12. And down here is 0. So I'll take away 0, gives you 12. 31st 12 2000 as per this example. If any value or any difference appears on the credit side of ledger, and if that specific account belongs to income statement, consider it as income statement expense. So let's balance off the irrecoverable debt account as per the same example. Find only on the debit side worth of 150, 150, take away 0, so 150 again, 31st 12 2006, income statement expense. Now let's enter this value, which is worth 150 for the current year on the income statement and under the category of expense. Now let's move to the next step. We are done with this. Now the last step. Balance of TR account. Trade receivable belongs to statement of financial position, and we enter it under the category of current assets. And whenever a specific ledger belongs to SFB, consider balance carried down and balance brought down. Debit side is greater, 20, 20, and the difference 20 take away 2 gives you 18. Balance carried down, 31st 12 2000, moving down to the next side, 1001, balance brought down, 8. Now let's do the same balancing in the original account. As you can see, debit side is greater, bring the 12,000 down, 12,000. Now from 12,000 take away 50, which gives you 11,950. Since the difference is on the credit side, income statement expense. Since the difference is on the credit side, you write balance carried down, bring it down to the opposite side, in 2007 as balance brought down, 7,950. Now let's show this impact in the statement of financial position. Trade receivables amount, closing balance 11,950. Now we have posted opening balance of irrecoverable debts and trade receivables. That was the first 2 steps. Then we identified the double entry of irrecoverable debts, which we debited irrecoverable debts and credited trade receivables. Next step, we balanced the irrecoverable debts account, and we found the difference on the credit side 150, and we write the difference as income statement expense. Whereas trade receivables account, we balance it off, balance carried down, brought down, because this will be transferred to statement of financial position. And followed by that, we had shown the impact in the 2 financial statements, income statement and statement of financial position.